Hey guys, Ron Parks here and welcome back to the channel. Let's talk about putting money away in a Roth IRA and a Roth 401k to make you a millionaire. How does putting $10 away a day into a Roth IRA sound to make you millions? Well, one of the best ways to save for retirement is with a Roth IRA. These tax advantage accounts offer many benefits. You don't get an upfront tax break like you do with a traditional IRA, but your contributions and earnings grow tax-free, and withdrawals during retirement are also tax-free. A Roth IRA is one form of an individual retirement account, just like you have a bank account where you have access to a savings and a checking account. You can open up a Roth account and have access to all of your investments. And here's how the Roth IRA works. First, you might ask, why use a Roth IRA instead of just a traditional IRA where you get the tax deduction now? Well, the significant differences between the Roth and the traditional counterpart hinge on when you pay taxes and how much money ultimately goes to Uncle Sam. Young people should go for a Roth IRA and allow it to grow for 30 or 40 years. Generally, you're in a lower tax bracket than you'll be later on, and the upfront tax deduction of a traditional IRA is really not worth as much because you're not earning as much. Now, you're able to open up a Roth account and deposit up to $6,000 a year if you're under the age of 50, and if you're over 50, you can contribute $7,000 a year. All the money you deposit into this account will grow entirely tax-free. And when you take your withdrawals starting at 59.5, you'll have all of those distributions also tax-free. So who's eligible? Well, contributions, as I said, are not tax deductible, but your eligibility to contribute to a Roth IRA is based on your income, your earned income. And if you file taxes as a single person, and if your modified adjusted gross income is less than $139,000 for 2020. And if you're married and file jointly, and your modified adjusted gross income is less than $206,000 for 2020, you can open an account and deposit the maximum. Now remember, the maximum total annual contribution for all of your IRAs combined, that's traditional and that's Roth, are $6,000 if you're under 50 and $7,000 if you're over 50. So let's go through each point and see if a Roth IRA is a good fit for you. First, what are the tax advantages? Well, contributions to your Roth account are non-deductible, which is different than a regular IRA. And with a standard IRA, you can take a tax deduction for the allowed contribution. But when you start withdrawing money, you're taxed at your current income tax rate. The good thing about having a regular IRA is that you can make deductions when your tax rate is usually higher than it will be when you retire, and therefore, when you do withdraw the money, it could be taxed at a much lower rate. With a Roth IRA, you don't get the tax deduction now, but there are many other benefits to having one. You can withdraw the principal, now that's the principal and not the earnings, with no penalty, and when you do start your withdrawals, they'll all be tax-free. But with a traditional IRA, investors must stop making contributions when they turn 70.5 years old, and you're forced to take distributions and begin paying taxes on that money. The Roth IRA has no required minimum distributions, so that means that you can live to 120 without ever tapping your Roth account. Plus, anyone with earned income can keep adding to their Roth IRA account regardless of your age, so you can continue deposits after 70.5. There are also cases where you can convert a regular IRA into a Roth IRA. So you might ask, why should I consider a Roth IRA conversion? Well, although you'll have to pay current income taxes on the conversion amount, moving your money can still be really advantageous. One, if you think you'll be in the same or higher tax bracket when you withdraw the money. Two, you won't need the converted funds for at least 5 years. 3, you can pay the conversion tax in cash. And 4, you want to leave a tax-free financial legacy to your heirs. The decision to initiate a Roth IRA conversion depends on your personal and financial situation. It should factor in the potential for a substantial ending portfolio balance, your estate planning goals, and your tax risk diversification options. Now let's talk about taking the money out of the account. Contributions can be withdrawn at any time without taxes or penalties. And any earnings can be taken out without taxes or penalties if you're age 59.5 or older and your account has been open 5 years or more. So how can you become a millionaire by starting a Roth IRA? Well, let's use this example. Let's say you put away $10 a day, that's $300 a month, into a Roth IRA starting at the age of 18. Since we want to be conservative, let's say you earn a return of 6.5%. If you start at 18, you'll have nearly $1.1 million tax-free at the age of 65. Of course, if your return is significantly greater than 6.5% on average, you'll have so much more. And when you start making great earnings, you can contribute the maximum of $6,000 per year starting at 18, and at an average rate of 6.5% return, you'll have $1.8 million at the end of the age of 65. Remember, this is all tax-free money when you start taking it out. And one advantage I talked about earlier is that you can withdraw all the principal you put in any time without a penalty. Traditional IRAs have a 10% penalty if you withdraw funds before 59.5. When you're young, you have so many years to build up this nest egg, and all of the interest and earnings will compound over time. Compounding makes you more money over and over again. And when you're young, chances are you're not making a great deal of money, which already puts you in a low tax bracket. Now, I want to be clear that a Roth IRA is only a legal vehicle to allow you to buy and sell investments in these accounts. A Roth IRA is not an investment. It's just a holding account for all of your tax-free and taxable investments. You can set up a Roth IRA through websites like Vanguard, Charles Schwab, or Fidelity, or any other number of places. All you need to do is just Google it. And once you have the account open, you will make investments like buying stocks or bonds or index funds. You can go through any of the company's brokerage sites where you open the account to make trading easy. And you can buy an index fund that tracks the market, such as the S&P 500 or some other benchmark. You can also invest in stocks and bonds and any other investment vehicle allowed by the rules. So to make this successful, you need to follow 4 rules. First, as of 2020, you're limited to $6,000 per year to contribute to this account if you're under 50. Second, you can take your principal out at any time, but you're prohibited from putting it back later. So taking money out can defeat the purpose of the tax-free and compounding growth effect. Third, if you take out any of your unrealized gains or your profits before the retirement age of 59.5, you'll have to pay a 10% penalty plus pay taxes on the money withdrawn, which will be considered ordinary income and will be taxed at your highest tax rate. And number 4, as a single person, if you make more than $139,000 a year, you'll need to do something called a backdoor Roth IRA. A backdoor Roth account is a way for people with high incomes to sidestep Roth's income limits. A backdoor Roth boils down to some fancy administrative work. You first put money in a traditional IRA, and then you convert that account to a Roth IRA. You pay the taxes, and you're done. And even though you didn't qualify to contribute to a Roth because your earnings were too high, you get to go in the back door, no matter what your income. And that's good news because your money grows tax-free, and that's a pretty picture. If the rollover from your traditional IRA to the Roth is done too soon, the 2 transactions could be viewed as one transaction, which would result in an excess contribution to your Roth account. Now, there are many pitfalls in doing a backdoor Roth, so I recommend speaking to your tax accountant. And one last thing to keep in mind is what happens when you die, and what impact does a traditional IRA or a Roth IRA have on your beneficiaries. Beneficiaries must pay taxes on the money they withdraw from traditional 401ks and IRAs, but your children and grandchildren and any other beneficiaries may be able to receive tax-free distributions of the money you leave them in a Roth 401k or a Roth IRA. So if you're never going to need this money, it makes sense to consider a Roth account and let the assets grow until your children's generation. Now, you don't have to make any withdrawals, they're not required. And when your children have to withdraw, they'll never be subject to tax. So to summarize, a Roth IRA could be a great vehicle to get tax-free withdrawals when you retire. And if you're expecting that your tax bracket will be lower in retirement, then you should consider starting a traditional IRA, because those contributions are tax deductible and you'll probably be at a higher tax rate. So I hope this helps a little of outlining some of the advantages and disadvantages of a Roth IRA account. And if you enjoyed the video, I would really appreciate it if you can smash the like button for the YouTube algorithm and subscribe. And of course, any comments and suggestions will be really appreciated. So just click below and put them in. And until next time, thanks.